All right, it is case study time. We're going to have a ton of fun with today's case study, looking at some actual numbers with someone who had recently reached out to us. Hopefully, the numbers and situation that this individual went through speaks to you a little bit, whether the numbers are the same or we could take a zero away, add a zero. Hopefully, it provides some value with respect to how to maximize the cash value in a whole life insurance policy, and then how to effectively use the money. So, this was an individual who had reached out to me. She actually emailed me directly. I wasn't aware my email's really out there that much, but she had got a hold of it and she had sent me a note, and she had a pretty clear picture on what she was looking for. She knew ballpark figures of the amount she wanted to dedicate to the policy. Originally, she wanted to fund it for a short period of time, 5 years. But then as we continued to talk, she said, you know what, I like the idea of heavily funding this policy for 5 years, but I might want to keep going. So when we design the policy, let's set it up so I can continue to pay into it aggressively after 5 years, which she can. But 52-year-old female, real estate investor. This is exactly why she's taking out the policy, for the purpose of real estate investing, and then also potentially to take income from the policy on a tax-free basis down the road, as we can do that with cash value life insurance. The desired funding. So right out of the gates, she wants to fund this policy aggressively. We've got $270,000 per year for the first and second year. So taking a lump sum of cash that she is banking on, she knows that she'll have that. This is the amount of money she knows she can really just lump sum fund a policy with. 270 years 1 and 2, then $180,000 years 3 through 5. This is based on cash flows being produced from real estate investments. Her actual investment is much higher. I never like to ever take all of the proceeds from one's real estate and put it into a life insurance policy, just because there are other areas to position money. This is a great area to store cash and use it for investments, but we don't know what's going to happen with the real estate investments. They are subject to change over time, so we shot it a little bit conservative, years 3 through 5. The income is expected to continue after year 5, but what she wanted to see, was stopping the payments altogether at year 6, or potentially paying up to $100,000. And that's a range too. So she doesn't want to be committed to anything, but if things continue to produce and she doesn't need or want to take income from the policy, she wants the ability to continue to pay up to $100,000 per year. And you can do that with a cash value life insurance policy without making the decision up front. Let's continue. Company selection. So a couple things were of concern to her. She wanted an insurance company that has a track record of delivering the strongest actual, not illustrated, but actual cash values to a policyholder, to her in this case. So I talk about what? Properly designed policies, which we'll touch on in a second, and the 4 major mutual companies, being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We're primarily going to focus on Mass Mutual and Guardian in this example, and that is primarily, for full transparency, who our company uses more than any other carriers. We do use others, but those 2 are the heaviest. And the main reason why is, first and foremost, the quality is there. We've seen them consistently deliver strong cash values to policyholders. But then number 2, a policy can be designed where it can be extremely flexible. To provide some information, because this was very important to her, specifically on the flexibility. Mass Mutual is a company that, if the policy is designed properly with the correct riders and such, you as a consumer, if you own a whole life insurance policy, can make payment adjustments 1 time per year, every year, without any medical underwriting on your policy anniversary date. Now, sticking on Mass Mutual, there are ways to make it a bit more flexible. Some people are not aware that you can actually add unscheduled PUAs, which through their planned additional life insurance rider, up to 3 times per year, meaning you just add funds at leisure. But there are some additional limitations I have to be aware of with a 2-year window and such. We like to provide that info, but at the same time, keep it simple. To summarize, Mass Mutual works very, very well if I want the ability to adjust payments 1 time per year on the anniversary date without any underwriting. You can do a lot of damage with a Mass Mutual policy in a good way. Guardian, on the other hand, with respect to their flexibility. They are one of the most flexible companies out there, period, in my opinion. They are a company that if she wants the ability to pay up to $270,000 per year, she can commit to the minimum premium only, pay that and the term rider only. She can pay that yearly or monthly if she wanted to. And then 100% at her discretion, she can just add more money into PUAs at her discretion. So extremely flexible. Now, a weakness to Guardian is if you want that flexibility where you can 10x the base premium in PUAs per year, they work very, very well if someone said, I want to max fund this thing for 10 years or less. After that, maybe I'll pay a reduced amount or zero. That's Guardian's sweet spot. MassMutual, you can keep on max funding it for a long period of time, but we've got other content on other videos. My point is, during the actual conversations that I have with her, and we do this with everyone we work with, we're asking questions, seeing how long you want to pay into it, how much you want to pay into it, how much flexibility, showing you options with different companies and such, so you can see everything up front and then make an educated decision based on the actual numbers that you see. So with the policy design here, most important thing when it comes to a high cash value life insurance policy, designing it properly. If she wants the ability to pay up to $270,000 per year, how should this policy be designed if her goal is maximum cash value? Well, we want to copy exactly what corporations do when it comes to maximizing cash value. Here's what they do. So where's the money going? You go toward one of these two areas, toward the premium piece, which you're going to find we can set that as low as $27,000. One of the examples, you'll see it actually at $24,000 and change, but you'll find with MassMutual, we can have a minimum base premium, typically of 10% of the total desired payment. With Guardian, the true minimum base is typically about 9.1% to be very precise, but that's as low as we can go if we design it properly. So I'm just going to round for this example. The premium, we have at $27,000. We'll have a term rider attached. This will be around $2,000 per year. We can actually design that with a one-year term rider, which we used examples with level term riders and one-year term riders in her case. And then throw everything else into PUAs, which $29,000, be about another 241 in this case, just to be precise. There we go. Plowing everything else into PUAs, which hypergrow the cash value. Because what happens with premium dollars? So if you're considering a whole life insurance policy and you want to know, hey, when I pay money into the product, where does it go and what's the impact? Because when I look at the base premium of a life insurance policy, no matter how I slice it, that typically does not show up in cash value in the first year. That is a lost opportunity cost, again, no matter how I slice it with a traditional type of policy. We're going to look at different types of products here too. The reason why it doesn't show up is because the company is going to overcharge me for the cost of insurance or the death benefit up front. The term rider, the purpose of that, it builds zero cash value, but it's a nice way to buy me additional death benefit. Or if you look at this and say, I don't care about the death benefit, because most people we work with don't care about the death benefit. They're very, very expressive about that, and I get it 100%. Is the death benefit is the number one driver of that MEC limit. So in her particular case, we want to make sure that the cash value keeps the core benefits, which are what? Core benefits of a whole life insurance policy, focusing on the cash value, safe, liquid, tax-free. Tax-free if we don't trigger a taxable event, one of which being a modified endowment contract. So in these cases, because her plan is to fund for a maximum of 5 years, maybe more, but at a number much lesser than the MEC limit that's required, we're going to set the death benefit at the absolute minimum number, which gives us a $270,000 MEC limit. Technical stuff, right? Which you don't need to know all of this when you look at the numbers that you'll see shortly. They'll speak for themselves. But what this allows one to do, minimize expenses, name of the game, and plow everything else into PUAs, which is money you can access right away, begins to earn the guaranteed rate, dividends, everything accelerates, which again is exactly what we want. The PUA dollars do buy you some additional death benefit. So, shall we look at some numbers? I forgot one important thing. After looking at the growth, how to maximize the cash value, that's what she wants to do first. And everyone that our company talks to, what I've always said for years, if someone wants to use their cash value life insurance policy for real estate investing or for whatever it might be, my advice is, when you look at these policies, the first thing you want to aim for is maximizing the cash value. Because what that does is just give you more cash, call it more operating capital, that you can then use for real estate investing, paying off debt, investing in your business, whatever it might be. So, with that said, when it comes to policy loans, there are differences when it comes to the loan features of MassMutual and Guardian. Specifically that MassMutual offers both non-direct and direct recognition, depending on what product you select. If you go with the variable loan rate, you're going to have different rates, where Guardian just has a fixed loan interest rate of 5%. And then at year 10, you can elect the variable loan rate, which changes the policy from direct recognition to non-direct. But that's another conversation or a great topic for another video. So her plan is to use the policy, but through a cash value collateral loan, which involves taking a policy to a bank, to a lender, assigning your cash value to them as collateral, a lot like a HELOC, a home equity line of credit. When you assign that cash value to them as collateral, a collateral assignment is placed on your policy, meaning you cannot go in and take a loan unless the bank signs off on it. You cannot go in and change owners, change beneficiaries unless the bank signs off on it. So those are some drawbacks to a collateral assignment. The advantage is we get a loan, typically in the form of a line of credit from the bank, which is typically around 3%, between 3% to some lenders are at 4%, but it's very easy to find the 3 to 3.25% range, which makes it very, very attractive, especially when I measure the internal rate of return on a life insurance policy. If it's properly designed, it'll produce somewhere between a 3 to 5% net IRR. So if we just call that 4% for simplicity, and I'm able to leverage it at 3%, that puts me in a positive situation, a positive spread. Keep in mind, what's the worst year of a whole life insurance policy? The early years. You are going to be in the red, meaning negative in the early years, and you're going to see that in the numbers. And in fact, let's look at the numbers because I've been talking about this quite enough, haven't I? Yes. All right. So what we will start with here is a comparison of, we've got a Guardian option, assuming just their basic dividend rate, and then two MassMutual options. So when I say their Guardian option with just their basic dividend rate, is Guardian does offer that indexed rider. We'll often attach it to policies, but at 0%. And in that case, it's a dividend-paying whole life insurance policy. But it's a nice rider to attach. If you ever want to turn it on, it grants some greater earning potential. But there is a fee that comes with it, which we need to be aware of. But we've got a video on that. Just type in index in our channel, and you'll see info pop up. So here we go. Guardian policy, dividend, whole life 15 pay, which means you can pay into it for a maximum of 15 years, and then the 10 pay option. Now, her goal, it was very clear, was funding it for 5 years. But a couple times she mentioned maybe longer. We're going to look at an option. So here, we've got $270,000 going in. If this is me, and I can look at the spreadsheets like I can as an agent, but if it's me as a consumer, I would ask, okay, of that $270,000, where is it going? Because if we go back to the whiteboard demonstration, money can go where? Toward the premium or toward the PUA component. So where is my money going? Well, the answer, here's the actual illustration. Money can go where? Premium or PUA. Full disclosure, oopsie daisy, there we go. Premium, right here, $24,000 and change. Where we came up with that number is we can 10x the base premium in PUAs per year. So she had a total desired payment of what? $270,000. So I wanted to squeeze it down literally to the penny The base premium, that is, because that minimizes expenses, minimizes the upfront hit, because premium dollars, with respect to your cash value in the first year, do not show up. A couple $100 do in this case, but it's next to nothing. That takes the biggest bite out of cash value in the first year. Some products, it's the first and second year. So how do I minimize that to minimize the pain point on whole life insurance and the number one reason why people don't do it? The upfront cash value, and it takes time to break even. So that base premium gives me a whole life death benefit in this case of $878, call it $880, which would give her a MEC limit in this particular case of what? 4.27 is this guy is the total death benefit. That gives her a MEC limit of 270. So the 800,000 and change would be just around $45K. She's paying in $270,000. So that's the whole life death benefit, but we have a total death benefit of 4.27 million. So what we did here, because in these case study videos, we want to provide details on exactly what to do, or the question is to ask your agent. If you're working with us, we'll do this for you. This total death benefit, 4.27, that's what gives her the MEC limit of 270. So to get to that 4.27, there's two ways she can do that. One, she can increase her premium, which will hurt, particularly in terms of cash value. She's also on the hook to pay that premium, where she wants a minimum commitment, not a high premium. So instead of raising that, we could raise it. That's one way to raise the death benefit, but it's not a good way in most cases. The other way is this guy, target additional benefit, which is term insurance. This is a term insurance rider, which is a cheap way. My apologies if you don't like the word cheap. If you don't like the word cheap, I like to slide in cost-effective way to raise the death benefit, which raises the MEC limit. Here's the cost to the term rider, and this will decrease over time. So here we go. As we look at the chart, you'll see this match the Excel spreadsheet. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.